All right, so here we go. We're ready at long last to study options. Now, I do want to point out that what I've done here in Blackboard is I noticed that the notes that I had posted for chapter or section 5 options, there was a lot of material in there that we won't have time to cover. And also there were issues with the graphs for some reason in the PPTX version. So what I did was I took the what used to be called Introduction to Options and Introduction to Options Appendix, and I consolidated them into a single file called Introduction to Options Updated. Okay, so actually I realized I just put the wrong one in here, didn't I? Hold on one second. Yes, because there's an awful lot of content in there that we won't really have time to get to. We really want to focus our attention on the basics of options so that when this is done, we can then focus all of our attention on pricing options. There's a lot of interesting theoretical results in what used to be called the appendix, but there really isn't enough time to go through all of them unless you want to read them on your own. But what we're going to cover is in the file that I'm now calling um, Introduction to Options Updated. Now it's here. Okay. The one thing that I find very, very frustrating is that that I'm using PPTX PowerPoint files here so I can write on them. PDF doesn't, it technically has the capability of letting you write on it, but it's very awkward and clumsy in my opinion. But the only thing then is that if I write on these and then I save them as PDF, for whatever reason, the writing that I do does not show up in the PDF version. So, it's really kind of awkward. So what I would like to do is just keep using the PowerPoint slides and write on them with the understanding that the any writing that I do will not appear in the PDF version. I don't know why that. Who knows why this stuff happens? But anyway, one good thing though is that my tablet finally got fixed. So I've got my nice tablet. I've got an older one that works okay, but I've got a really nice, expensive new one, which of course stopped working properly less than a year after I bought it. And they somehow managed to figure out how to get it fixed. For some God only knows why reason, the software got corrupted and it just wasn't working. Okay, well, anyway, let's get started. So, as we mentioned last time, an option, as the name suggests, is a derivative security where you have the right, but not the obligation to buy or sell an asset in the future where the price is agreed on today. So it sounds a lot like a forward contract. The main difference is that with a forward contract, you're entering into a legally binding agreement to buy or sell in the future with a price that's agreed on today. So what's the big deal? Well, here you have the right to change your mind. You can walk away from the whole thing when the time comes to take or give delivery of the asset. All you have to do is say, I choose not to exercise this option. And that's the end of it. There's no legal ramifications. It's your choice. And that's what makes them so powerful. And that's also, though, what makes them so expensive. Okay. So, in other words, with forwards and futures, there really isn't a price as such. Um, the forward contract doesn't cost you anything to enter into it, it's just an agreement. Okay. Now, there might be fees and things like that, but the actual contract itself doesn't have a price. And the same thing is true with the futures contract. You may have to put money into a margin account, but you're not actually paying for the contract. This is different. The option means you're buying it, you're paying a specific price, and then whether you use it or not, you never get that money back. Just like with an insurance policy, if you buy insurance for your car and you never crash your car, you don't get your money back. You're paying that as a protection against things potentially going wrong with your car. The same thing is happening here. You're paying for the right to do something. Whether you do it or not doesn't affect the fact that you have to pay for it. Now, options are characterized by several key features. For one thing, an option can be written on a large number of different assets. In other words, the option is itself a type of contract, although it is traded in the marketplace in the same way that a futures contract is, where the contract has to specify what is it that you have the right to buy or sell. Now, as we saw with futures and forwards, there's a lot of things we can buy, like gold and currencies and stocks and stock market indices like the S&P 500. But with options, the possibilities are almost endless. You do now see options written on assets that are not really financial assets at all. For example, interest rates. You can buy an option where the underlying asset is itself some specified rate of interest. And it gets even stranger. It's actually possible to buy an option on external events. For example, it's possible to buy an option on the temperature or the rainfall for a certain length of time or the snowfall. So, why would you want to do something like that? Well, imagine yourself being a farmer. And you know that if you don't get a certain amount of rainfall, your crops will fail. So you can actually go to a brokerage house or an investment bank and negotiate an option where if the rainfall is not enough to support your crops, then you'll get a payment from the investment bank. Okay, so now it took a long time for all of these different types of securities to become available. In 1973, when options trading first got started in the United States, all that they had available was equity options. And even then, there was just a handful of them. Well, if that's not what you wanted, well, that was too bad. It took quite a while before all the others were introduced. But once they got started, many of these types of options were introduced. In fact, quite a few of them came out in the late 70s when it became clear how useful options really are. Okay, for example, currency options became available in 1976, interest rate options became available in 1979, and then we go on and on. And so as the market expanded, more and more types of options became available, and now the number of possibilities is almost unimaginable. So anyway, yes, so here's some of the things you can buy an option on: interest rates, currencies, equities, which means individual stocks, equity indexes like the Standard & Poor's 500 or the Dow Jones Industrial Average, precious metals, gold, silver, platinum, for example. Now, here's where it gets interesting. You can actually buy an option on a futures contract. Well, how does that work? Well, if you own an option, let's say I buy an option to enter into, actually, let me sneak this in here. It is possible to buy an option on a futures contract. For example, an investor may buy an option which provides the right to enter into a long futures position on gold with a futures price of, let's say, $1,800 per ounce. So what that means is that if this option is exercised, the investor has the right or will obtain a long position, this futures contract, which can then be used. Well, here you can do one of two things. You can either buy the gold when the contract matures. Oh, for God's sake. To either buy the gold, the contract matures, or unwind the position, as we saw in the previous section, that it's possible to get out of a futures contract, not exactly get out of it, but offset it by taking the opposite position in the opposite contract, the same contract. So you can either buy the gold when the contract matures, or else unwind the position and collect collect any profits that may occur. Now, the advantage of this This means that the investor does not have to take delivery of the gold in order to realize any profits. So there's what it is, it's a way of avoiding the requirement that you must buy the gold. If you buy an option directly on the gold, that means if you exercise your option, that means you're going to actually buy the gold at the price that's been specified and take delivery of it. That may not be what you want. If you're a gold dealer, for example, that works out just fine. I mean, all you're really doing is locking in a price. But if not, if you're simply speculating on the price of gold, or else you're just trying to hedge the risk of owning gold, you may not want to actually take delivery of the gold. So one possibility here is, rather than just simply buying a futures contract, you can buy an option on a futures contract. And the advantage of that is that you can change your mind down the road. With a futures contract, you can offset it, but you can't actually get rid of the position in the way you can with an option. So these types of options, by the way, have an interesting name. They're called futures options. Okay. And by the way, there also exist forward options where what you're actually doing is buying with an option the right to enter into a forward contract. So those are called forward options, but these are much more common. Futures options are very popular because, again, they avoid the necessity to actually buy the asset if we don't want to, but also they're very liquid. In other words, if you have a position, it's easy to unwind it. And so it turns out that at this point in time, most options that trade in the marketplace are in fact futures options. Okay, so this proved to be a very popular type of position. And by the way, in case you were wondering, and we'll discuss more of this later on, there do exist options on other options. In other words, you can buy an option that gives you an option of another type, and those options can be futures options. So you can imagine yourself in a position where you have an option on a futures contract. So you're basically 3 steps removed from the underlying asset. There's all kinds of products trading in this market. It's quite exciting and interesting. The things that people have come up with over the years, the clever ideas, the ways that people use options is quite interesting. But anyway, so futures options are very popular. But some assets can only be bought with just an option. In other words, as you remember from last time, futures are not available on every asset in the economy. In fact, the number of different futures contracts is actually somewhat limited. For example, if I needed to buy Swedish kroner, I'm not going to find a futures contract on Swedish kroner. And so what other choices do I have? Well, I can actually buy an option directly on the kroner, but there's not going to be a futures option available for it. So every situation is different. So investors, hedgers, speculators will choose the contract that makes the most sense for their particular situation. All right, anyway, currency options typically are futures options. Equity options are usually not futures because there do not exist futures contracts on individual stocks. So if I buy an option on Apple, for example, it's an option to buy the Apple stock, which then gives me the right to buy it. And if I want to exercise my option, I have to actually buy the Apple stock. Okay. Now, here's some of the bizarre ones I was mentioning before. We have options on the temperature, on rainfall, and snowfall. These are obviously very specialized cases, and but they do exist. Okay, there are investors out there who need these, and so they are available. Now, the price at which you're able to buy or sell is called either the strike price or the exercise price. If you recall, with the forward contracts, this was called the delivery price. Okay, in other words, the price at which the asset is being delivered. Here we have a different name for it. It's called either the strike or the exercise price. And in this context, the word exercise means that you actually use the option. In other words, whatever right you've been given, you choose to use or exercise that option. The maturity, now, like all other securities in the market, except stocks, let's say, they typically have a maturity date. So you have a fixed length of time to make up your mind what to do, whether I use the option or not. Once we get past that deadline, then the option expires if it hasn't been used. Okay. So you only have so much time with this option to buy or sell the underlying asset. Now, also, here's what we also need to know. The options that let you buy something, instead of calling it a long position, this is known as a call. A- the one that gives you the right to sell is known as a put. Okay. So the terminology is a little bit different here. A call gives you the right to buy. A put gives you the right to sell. And on top of that, there's more classifications. European options can only be exercised on the last day of trading. In other words, the expiration date. In other words, if I bought a call option on Apple stock and it's a European option with a maturity date of, let's say, July 1st, I have to wait until July 1st to decide if I want to buy the stock or not. But if it was an American style option, I have to every day until that maturity date arrives on July 1st, I can call up the broker and say, listen, I want to exercise this option, or just hang on to it until I decide that I do want to exercise it. So clearly, the American style option is more valuable than the European style, but as a result, the American style option is more expensive. Of course it is. It has to be. All of these features are going to determine the cost of our option. The more valuable, the more powerful, the more flexible the option is, the more expensive it's going to be. Okay, this is one market where you truly get what you pay for. Now, having said that, some options are only available as a European style option, and some options are only available as an American style option. Some are available in both forms. Okay, for example, interest rate options tend to be European options, and stock index options tend to be American style options. What it really comes down to is, what are you really trying to do with the option? What kind of exposure are you hedging, that type of thing. But so that's how it normally works. Now, these are only the basic options, the standard ones. They're sometimes called plain vanilla ones. These are the ones that most activity in the markets is based on, these plain vanilla options. But there are many, many others that are far, far more complicated than this. And they're all collectively known as exotic options. Now, I did post in Blackboard files here. These are our discussion that we'll be briefly looking at of exotic options. And so we don't need to spend a whole lot of time with this, but I just want to give you a sense of how involved they can be. There exists, for example, an option called a chooser option, where you buy the option and you have a certain length of time to decide if you want it to be a call or a put. Oh, that's kind of interesting. You may buy this option and say, well, I don't know. Maybe I'm worried about the price going up. Maybe I'm worried about the price going down, but I don't know just yet. So you'll be given the right to decide in the future, but of course that makes it even more expensive. But if, depending on your circumstances, you may actually want to have one of these options. So there's all kinds of bizarre forms of options. These are the standard ones, the plain vanilla ones. Most trading takes place with European and American style options. Now, here we mentioned this a few times. The price of an option is called the premium. And again, unlike these other derivatives, an investor has to actually pay for an option. And of course, now here's why, because with an option, there's a maximum amount you can lose, and there's no limit to how much you can make. Wow, that's a pretty sweet position to be in. The loss is limited to whatever you paid for that option. If I paid $10 for an option, I can never lose more than $10. Not so with futures contracts, as Nicholas Leeson found out to his great cost. You can lose a lot more than you started out with if you're not careful. But here, the maximum you can ever lose is whatever you started out with. And yet at the same time, there's no maximum profit. There's nothing to limit your profits. Wow. So that imbalance puts things in favor of the owner of the option, which is one of the reasons why we have to expect to pay for it. Now, here's the interesting thing. Options are what we call leveraged, which means, let's say I own an option on gold. It doesn't take a huge change in the price of gold to give me a very high rate of return on my option. But it also means that a small change in the price of gold could also wipe out my position. Okay, so in other words, it doesn't take a whole lot of activity in the gold market to have a dramatic impact on my options positions. And this is one of the reasons why these are so popular with speculators. They want to earn a lot of money in a hurry, and they might be able to do that if they're correct about what's happening in the market. So in other words, if I own gold, of course I'll profit if the price goes up, but a 10% change in the price of gold, if I have an option, might double or triple my money. Okay, so these are heavily leveraged. Depending on the circumstances, a 10% increase in the price of gold could potentially cause the value of my call option to go up by 200% or more. There's no limit here. It could go up even more than that. But worst scenario, worst case scenario, I can not lose more than I started out with. Now, we're going to start by introducing this concept of the payoff. So how does this work? All right, let's quickly look at an example. An investor buys a call on gold. The strike price is 1,500. That's the price that I have the right to buy it for. It expires in March the 1st. It's a European option, so I have to wait until next March to decide whether or not to buy the gold with my option or exercise the option. Now, imagine March 1 rolls around. The market price of gold has gone up to $1,700 an ounce. I have the right to buy it for $1,500. So of course I'm going to do so. I'll use my option to buy for $1,500. And if I choose to do so, I can then turn around and resell it in the market for $1,700. Look at that. So the payoff, by the way, we're using the letter S to represent the spot price of the asset. X will be used to represent the strike price. I just put $200 in my pocket. Okay. That's what we mean by a payoff. Now that is not necessarily, oh, by the way, what would have happened if the price dropped to 1,400? Well, I have the right to buy for 1,500, but would I? No. Why would I pay $1,500 for gold that I can buy in the market for 1,400? So I'll let the option expire. I will not exercise it. And if I need the gold, I'll go in the market and pay $1,400 for it. That being the case, I'm said to have a payoff of 0. Now, here's some terminology that you hear sometimes. In the options markets, if the spot price is above, now this is for the call option, by the way, if the spot price is above the strike, like it was here, then the option is said to be in the money. Okay. If these are equal to each other, the option is at the money. And you could exercise the option, but you would just be breaking even. And then here the option is out of the money, meaning the spot price is below the strike, and then you would lose money if you exercised it. So you will not exercise the option. You'll just let it expire and end up with 0 as your payoff. Okay, so good to know. All right, now here's an example with a call on IBM stock. expires on September 1st. Now, here we're introducing the premium. Now, if you notice, when we're talking about payoffs here, there was no mention of the premiums. That's coming next. Okay, because we have to take into account this $200 is not a pure profit because it doesn't take into account how much we paid for the option. Once we know that number, we can figure out the actual profit as well as the rate of return. So let's say that here's our IBM call on IBM that expires on September 1st. The strike is $50. I have the right to buy it for 50, and the premium or price of this option is $3, which comes out of my pocket, and I never get that back, no matter what happens. So I put together a little table here to show you the different payoffs at different stock prices. And here's the formula. And you notice the way it's written. Let's go back here for a second. So what is this all about? This is the spot price of the asset. And this is the strike price. Why is it written like this, by the way? It's what it's basically saying. It's a compact way of saying that payoff equals S minus X if the option is in or out of the or at the money. And now 0. Whoops, sorry. That's okay, which means out of the money. So it's the greater of the two, in other words. In the first case, S minus X is a positive number and under those conditions, and therefore that will be our payoff as long as the option is in or at the money. Okay. If not, if S is below X, we will not exercise the option, and therefore we simply get a payoff of 0. So this max S minus X0 is simply a compact way of saying it's the greater of the two, S minus X if it's positive, 0 otherwise. And so this is what we know is in calculus as a piecewise function, meaning that it has at least two different values depending on the independent variable. Okay. And so we're going to graph this in a very interesting way. In fact, oh, by the way, so let's just confirm that these are correct. So in other words, here, the option is out of the money. Oh, by the way, we often see that abbreviated OTM. I forgot to mention that. Oh no, I didn't forget. It's right here. ITM, ATM, and OTM. So this one is at the money. And then here we're in the money. And so you notice here, for the first time, we have positive payoffs. And really, all they are is the difference between these two numbers. So in other words, based on the assumption that we'll exercise the option under these, in these scenarios, these will be the corresponding payoffs. Here, we're just breaking even. It doesn't matter if we exercise or not, but here, it would cause us to lose money if we exercise. So we assume that nobody will do that, and therefore the payoff is 0. But how does this look on a graph? Interestingly, well, here it is. So here's the region where the option is out of the money. Here's the only value where of the stock price where we're at the money, because this is the strike price, which means that we're at the money. And everywhere else, we're in the money. If you notice down here, the slope is 0. And here, slope is 1. Now, then we have this sharp kink. This graph is said to be piecewise continuous. And if you recall from calculus, the derivative would be undefined exactly at $50, the strike, because there's a sharp break there. But here, everywhere else, the derivative would be the slope, which would be 0 here and 1 here. Okay, so this is the payoff profile, as we call it, of a call option. And by the way, if you notice, this line goes up forever. It doesn't actually stop. Here, it can only go down to 0, of course, but on the upside, this goes on forever. There's nothing to prevent the stock price from going to 100 or 200. And so our payoff just keeps going up. This is why we say that we can't have a maximum payoff. Now, once we take into account the premium, though, what we're calculating now is not the payoff, but the profit or possibly the loss. So the profit or loss is the payoff minus the premium, which we'll designate as C. C dollars will mean the cost of the call or the call premium. Now, this number can be negative, okay, but it can't go more negative than just C. In other words, if I subtract C from all of these payoffs, and we're going to assume now that that's $3, by the way. You can see on the far right over here, this column, this is our maximum loss. And then after that, once we get into the money down here, remember here we're in the money, these continue to rise with a slope of 1. But what happened to the graph? Well, we shifted it down. It's got the same shape, if you notice, but it shifted down by $3 because that's the price of the option. So we just shifted the whole thing down. The shape hasn't changed. The slopes are the same, but the position is different. And this actually represents the maximum loss. Now here, what we do have for the first time is something called the break-even point, which means it's actually equal to X plus C. So here that would be $53. After that, it's all money in our pocket. Okay. So we have maximum loss, 3, no maximum profit. Okay. So that's all we need to say at the moment about calls. Now we're going to switch our attention to puts. Now, puts are the ones that let you sell something. And now, of course, before I go any further, I just want to mention that calls really provide us with the opportunity to do 2 things. A call. Hold on 1 second. I dropped my pen. All right, hold on. A call enables an investor to hedge the risk of rising prices or speculate that a price, or all right, let's actually hedge the risk of rising prices for an asset. Speculate that the price of an asset will increase. Okay, in other words, if you're worried that prices are going up, you can hedge your risk with a call. If you think that prices are going up, you can make money, if you're right, of course, by buying a call. Okay, so either of these are possible with a call. All right, that's what they're for. When people don't buy them for the fun of it, they're doing this because they either want to hedge the risk of the price going up or else gamble that the price is going up, and if they're right, they can make money. All right, now the put is the one that lets you sell. Actually, I'll tell you what, before I forget it, I don't want to forget this again. I'm going to put this at the end of the put discussion. Oops. All right, let's try that again. So this is just all backwards for a put. The put enables an investor to hedge the risk of falling prices. Like if you're selling something, or let's say you're a gold mining company and you're worried that gold will go down when you sell it, or if you just simply think gold is going down and you want to gamble on that, speculate the price of an asset will decrease, then you want to get a put. Okay. All right. So let's look at puts. So this is the one that gives you the right to sell an asset, which means you're bearish on the asset. Now, what's interesting is that before puts came along, it wasn't really easy to do this, to speculate that prices were going down. With stocks, there's this procedure you can follow called a short sell, but it's very complicated and very difficult to carry out. And but here it's easy. If you think that Apple is going down, no problem, just buy a put. So the payoff is going to be the opposite of what we just had before. So I just remind you the call payoff looks like this. So this one is reversed. So once again, max simply means the payoff is the greater of. Okay. So everything is reversed. By the way, guess what is also reversed? I think I forgot. Oh, here it comes. This money thing is also going to work backwards. Because for a put, it's a good thing that the stock price is, or the spot price is less than the strike price. This is the same for both of them at the money, but these two are different. They're reversed. Okay. So when you say in, at, or out of the money, what you're talking about depends on whether it's a call or a put. But either way, in the money means you would have a positive payoff if you exercised. Out of the money means you would not exercise. Okay. And at the money simply means you're breaking even. Now, just like before, we have to take into account the premium that we paid for this put. And it's the same logic. It's the payoff minus the cost, or the put premium, as it's called. So why don't we do this? Why don't we look at the diagrams for a put? So we start out with, now this part is irrelevant, whether it's American or European. It doesn't affect the payoffs. What it affects is the time at which you're allowed to exercise the option. This is a put on IBM. It also expires on September 1st. The strike is 50 and the premium is $2. So here's the payoff profile. Now you notice here we have our payoffs up here when the stock price is low. Okay. Because again, here we are in the money. Here we're at the money. So we're breaking even. And then here we're out of the money. And so down here, we are not exercising. Up here, we certainly do exercise. Here, it doesn't matter either way. You're still just breaking even. So what do you suppose the graph looks like? Well, it's reversed from left to right. In other words, remember with the call, So you just imagine that we're flipping it around from left to right. They're symmetrical from left to right. Um, it's as if the vertical axis was a big mirror, and you look in the mirror and you see the opposite on the other side. And if you notice here, the slope is 0 when the option is out of the money. Here it's at the money, and here it's in the money, which means but the slope is actually -1 if you notice, as opposed to +1 for the put, or the call rather. Now, of course, just like with the call, we have to take into account the premium, and that's going to shift the whole thing down by P dollars. So here that would be $2. And if you notice here, all I've done is subtracted $2 from the payoff. So the graph looks like this. And so here we're out of the money. We have our maximum loss. It's $2. The break-even price is here, which in this case would be 48, X minus P. And then after that, we're making money. Here's one important way in which the two are different, though, even though they're symmetrical from left to right. Remember with the call, the price can continue to go up so the payoffs and the profits will go up forever. Here, there is actually a maximum profit with a put. There is a maximum profit of X minus C, of P rather. Hold on. Why is that? Because the asset price can't go below 0. Okay, now I have no idea what just happened there. That is one way in which the two are different. With the call, we don't have to worry about that. With the put, the price can't go below 0. So X minus P is actually the maximum profit. Okay. So other than that, the two are perfectly symmetrical with respect to each other. And that is really the only real difference between them. But you might say, well, then, it's not such a great investment, right? No, but X minus P is still a very large sum of money. In other words, in this case, that's $48. If I pay $2 for something and it becomes worth $48, I've done rather well. I think you'll agree. Okay. And as I said, we don't want to forget about this. The put, why do you want to put? Because you either are hedging the risk of falling prices, or else you're trying to speculate that the price of an asset will fall. And of course, that means if you're right, you'll make money. All right, now let us now go back. I think we did this once before. Let's go look at the prices of Apple options, Apple stock options, that is. And now let's take another closer look at the details. First, we need the ticker symbol for Apple stock. And then if you notice over here, they have options. Now, what you are seeing here, first of all, the expiration date for all of these is June 21st, which is next week sometime. If you want to look at some of the others, here they are. Now, they do go out quite a ways, but there's very little trading in the ones that go past a year or so. So we'll focus our attention on this one. And yeah, if you don't want to look at every single one of them, you can tone this, trim it down a bit. But what you'll notice here is that for the calls, and by the way, the puts are on the bottom. What do we need to focus our attention on? Well, we know what the asset is. We know what the maturity date is. The strike is right here. You can see there's a lot of strikes to choose from. And the price that you would have to pay for this is right here at the ask price. So, man, it looks like Apple's having a pretty good week. What's going on here? It was like 160 something last week, wasn't it? Yeah. All right. I don't know what happened, but look at these option prices. If you own one of these options, you'd be in pretty good shape right now. So for example, let's say the strike is, just to keep it simple, the strike is 210. That means you have the right to buy the stock for $210, but it's selling for 212.49. What price are you asked to pay for this? $4.30. Well, now that's interesting. Um, let's just take a look at this for a second. As of, what is today, the 15th? Apple stock is selling for, what did I say it was? 212.49. A call option with maturity June 21st and the strike price 210 is selling $4.30. So if you go back and revisit our graphs, let me draw another one here. So because the stock price is actually here, I'll call it S star. Now this line, this is a line with a slope of 1. Where it touches here is 212.49. But the actual price is up here somewhere, 430. Oh, sorry. Not what am I saying? It's not, no. It's not 212.49. It's 249. In other words, what you're seeing here is so here that would be 212.49 minus 210. 249 is our payoff. Okay, great. So, but here's the thing though, the market price is up way up here somewhere. So what just happened here? Being asked to pay $4.30 for something where the payoff is only 249. Why is this happening? Well, we're going to get into this more later on, but I just want to briefly mention that what you're seeing here is this. We need a second curve here. The black curve is the payoff profile. Which is sometimes called the intrinsic value. Now, the relevance of that is that this is the minimum price at which this option can sell in order to avoid an arbitrage opportunity. In other words, if you looked in the Wall Street Journal tomorrow and you saw this exact same option selling for $2, then you would, if you knew what you were doing, and we will figure this out later on, you would engage in trades that would represent you're taking advantage of this arbitrage opportunity. but the price isn't below 249, it's above 249. What's going on here? Well, this red line represents the market price of this option, which if you notice is actually greater than the payoff profile. What is this all about? So in other words, you as an investor are expected to pay 430, which for something which, if exercised today, would only provide us with an payoff of 249. The difference between these two curves is referred to as the options time value. What it essentially refers to is the idea that between now and June 21st, Apple stock could continue to rise and increase your payoffs. So what you're paying for here is the possibility that the price will continue to rise and your payoff will go up as well. So the first 249 is the intrinsic value. That's the minimum it can sell for. That is what it's actually worth if exercised. It can't sell for less than that. Otherwise, it would be an arbitrage. But it can sell for more because of this notion of time value. Now, by the way, the time value itself depends on how long it is until the next the exercise or expiration date. If instead of this being due on June 21st, it didn't expire until way later in the summer, then this number would be even higher. Okay, so in other words, the longer until the maturity date, then the higher will be the time value of the option. As we get closer and closer, if you were to look this up every day during the coming week, you would notice that the time value is shrinking. So on the actual expiration date of this option, let me just throw this in here. Actually, you know what I could do? I'm going to introduce another curve here. I'll make this one green. So the red one, let's say that's the market price on June 15th. And then the green one could be the market price, let's say on June 18th. So you see what's happening is the market price curve is getting closer and closer to the payoff profile. And on the expiration date, the two will exactly coincide with each other because the time value is shrinking. Okay. So in other words, as time elapses, by the way, we will come back to this concept later on, this notion of time value. But as time elapses, time value of an option continues to decrease and will be zero on the expiration date. At that time, the market price will exactly match the payoff or intrinsic value of the option. Otherwise, there would be an arbitrage opportunity, and we'll demonstrate that too. It would involve buying the underlying asset and selling, you'd be taking multiple steps, but you could certainly earn a risk-free profit if there's a discrepancy here. So it's getting closer. So there we go. And then the two will exactly match on June 21st. Okay. So this is how it works for a call. For a put, You can imagine it goes the other way around. The curves are getting closer to the payoff profile from right to left. And on the final day of trading, on the expiration date, the payoff will exactly match the market price. Okay, that won't change for either one of them. Okay, now here's an interesting twist. We hadn't thought about this up to this point. If I'm going to buy an option, somebody has to sell it to me. Okay. So just like with a forward contract and a futures contract, there's actually a counterparty. With the futures contract, I don't think I mentioned this, but with a futures contract, you're buying it through an exchange. So I go to the CME and I say, please sell me a long position in a gold futures contract. And they say, sure, put up your money in your margin account and you're all set. What you don't see going on behind the scenes is that they have matched you up with a counterparty, meaning somebody else who wants to sell gold, okay, through a futures contract. So here's your long position, here's somebody else's short position, and the two are matched with each other so that if there's any payments, they're going to, like, if I make money, it's going to come out of the pocket of the counterparty and vice versa. You, as the investor, do not ever find out who this counterparty is. It's confidential. It's the exchange is acting like a middleman. They're bringing you together without knowing who the other side is. And they also act as a guarantor of the cash flows in case your counterparty disappears or something. Here, it's a little different. Well, it can be different. So you've got a buyer and a seller. And so now, by the way, here's one of the most interesting things about options. I'll just summarize this here. Forward contracts can only be obtained in the over-the-counter market. That's because they're so specialized that it wouldn't make sense to have an exchange trading them. Futures are only available through organized exchanges. Okay, they're heavily regulated. They're only available through exchanges. Options can go either way. Okay, in other words, you can buy options through an exchange like the CME, especially futures options. Obviously, you have to come from an exchange, but you can also negotiate them privately with another counterparty, like an investment bank. So it can go either way. And by the way, that's why it's possible to have these wacky options up here. Temperature, rainfall, these were clearly not bought through an exchange because there isn't enough demand for them. These would have been negotiated with a counterparty. Okay, so the ones that are a little odd, and those exotic options I talked about earlier, those are all done through the over-the-counter market where we negotiated directly with probably an investment bank. But the standard ones, like options on gold, let's say, you can get those in the over-the-counter market if you want, but they're also going to be available at the CME. Okay. In fact, if you want, you can go back to the CME's website and look at all the different options that they have. And it's the ones you would expect, like options on British pound, the Swiss franc, on gold and silver and platinum, on the very heavily traded assets, but not, let's say, copper or something like that. If I'm a metals dealer and I need a contract on copper or zinc or metal, I'm going to have to go into the over-the-counter market to get it. By the way, I left one out. You can actually get options on earthquakes. I mean, there's all kinds of crazy things you can get because somebody's going to need this. A farmer might need one to protect himself from cold temperatures or not enough rain, or a ski resort might need protection against not enough snow. So that's why these can be negotiated. They do exist. All right, where were we? Oh, what we're getting into is this idea that there's a counterparty. So with an over-the-counter transaction, of course, I do know who my counterparty is because I'm negotiating the contract with them. Like if I approach Goldman Sachs and I want an option on copper, of course I know who they are because I'm signing the contract with them. But if I go to CME and get an option on gold, I won't know who the counterparty is. Okay. It doesn't matter who it is because they're guaranteeing the contract anyway. But so there's a counterparty. Now, every dollar that I make is coming out of the pocket of my counterparty. That's an important detail. Between the two of us, we're always going to have a net profit of zero. We can't both make money. We can't both lose money. I make a dollar, my counterparty loses a dollar. So that means that their payoffs and profits will be very different than me, the owner of an option. So I'm the buyer, they're the seller. In order for me to make money, they have to lose money. So what we're going to do now is go through and show how the profit and the payoff formulas are different for the sellers of these options. And we're going to discover that the sellers are in a terribly, terribly risky position. Okay. In other words, when you think about it, if I, as the owner of the option, can't lose more than I started out with, what does that say about the counterparty? Oh, it means their position is pretty potentially, it potentially could be very bad. So anyway, why don't we save that for next time? We'll look at the payoffs and profits and losses of our counterparties, and then we'll start to address or look at some interesting options trading strategies. And when we're done with all this discussion, what we're going to do is we'll take a quick look at the exotic options, and then we'll start to focus our attention on option pricing theory. Okay, that's where it starts to get much more intense. So anyway, we'll save that for next time, and I'll see you then.